Okay, so the Bank of Canada just cut interest rates a quarter of a point. So why did they make this move? Let's break it down. Number one, slowing inflation. The Bank of Canada has been fighting inflation for the past 2 years, and we're finally seeing it cooling down a bit. Core inflation is trending closer to the target range, meaning prices aren't rising as aggressively as before. However, higher borrowing costs have been putting pressure on consumers and businesses, leading to the Bank of Canada to ease up slightly. Number two, economic growth concerns. Recent economic data shows slower GDP growth and weaker consumer spending, which means Canadians are being more cautious with their money. A lower interest rate is intended to stimulate spending and investment, particularly in sectors like housing, business expansion, and job growth. Number three, geopolitical challenges and global trade pressures. Beyond our borders, geopolitical tensions such as the conflicts in Eastern Europe, rising tariffs between major economies, anti-U.S. economic policies from global players are creating uncertainty in the financial market. Now, these factors will impact trade, supply chains, and overall confidence in the economic stability. The Bank of Canada is taking a proactive approach by making borrowing more accessible to prevent further slowdowns. Number four, U.S. policy and the Canadian dollar. The U.S. Federal Reserve has kept its interest rates steady, and with Canada's rate now lower, this can put downward pressure on the Canadian dollar. Now, a weaker Canadian dollar makes imports more expensive, which could lead to higher inflation. However, the Bank of Canada is balancing this risk against the need to support domestic growth. Number five, tariffs and trade friction. New tariffs on key goods, along with growing trade tensions between the U.S., China, and other global players, could impact Canadian exports and supply chain costs. The Bank of Canada is considering these factors as attempts to navigate these economic headwinds while keeping inflation in check. Now, what does this mean for you? Lower mortgage rates. Buying a home just became more affordable. Number two, better financing. We have more opportunities now to lock in a lower rate and save. Number three, more buyer confidence. The real estate market could see more activity as borrowing costs go down. So going forward, what's next? Economics predict that if inflation remains stable, we may see more rate cuts later this year, making homeownership even more accessible. So if you're thinking about buying, selling, refinancing, now is the time to strategize. Let's chat about how this impacts your real estate goals. DM, call, drop a comment below. Let's chat. The market is shifting, so make sure you're ahead of the curve.